But investors appear to be steering away from high-risk investments amid this volatile market. I was just talking about China. Those lockdowns are still in effect in meaningful ways, and inflation fears causing chaos in the United States.
Daniel Moore from Investors Mutual joins us live to talk us through what's happening. Welcome along. Markets are a little bit more settled at the moment than they were a few days ago, but of course this might be just the calm before a further storm. How are you seeing things at the moment right now, given the fact that we do have these concerns about rates and growth?
Look, it's a very volatile market right at the moment, and I think to talk about where we are today, I think we've got to really think about where we've been over the past 2 years. And if we go back to 2020, we saw, post-COVID, we saw enormous stimulus. We saw $5 trillion of quantitative easing from the Fed, and then we saw massive government stimulus as well. That created this enormous speculative boom, and we're now starting to see that unwind. And how fast that happens and occurs, really depends how fast interest rates go up.
Yeah, so we're in that sort of hangover phase right now as we come down from this sugar high. So the obvious places have been hit. We're talking, really high growth tech, non-profitable tech, meme stocks, crypto, all the likes. But we're starting here in Australia to get some profit warnings coming from, mining services. Pro-pack packaging, for example, had a warning out yesterday, inflationary costs, supply chain issues. Is there really anywhere to hide in this market?
No, we absolutely think so. I mean, if you think about the inverse of what's happened over the past 2 years, we've had the speculative stocks go up many-fold. And if you look at the more sort of established, profitable companies, they were really left behind and trading on very reasonable multiples. And what we're seeing today is the opposite. So as the speculative stocks are falling 50, 60, 70%, these sort of more well-established, profitable companies are catching interest and are actually performing very well in the current environment.
So is this sort of back to the future where we're in a market environment once again where company profits in the short term actually matter and investors don't have to look out 20, 30 years in advance in a low interest rate environment to try and find the winner, the next big stock? Yeah,
it happens every cycle, and when the cycle's very strong and it's very late stage, investors are very optimistic and are really interested in companies that have great futures. But when that cycle starts to turn and people start to worry about recessions or higher interest rates, the focus turns much more onto companies that have profits today and pay dividends today.
So this is perfect for you all at Investors Mutual.
Yeah, I mean,
when if boring can be beautiful, right?
Yeah, well, it's funny. I actually we used the word boring in the article we wrote as a bit of a tongue-in-cheek comment about these companies, and I had a CEO from one of the companies we mentioned just gave me an email, and I said boring is beautiful. It's in this market, and he totally agreed. But look, they're fantastic companies we're invested in. They're leaders in their field, often globally. And have been delivering good results for a long time.
Okay, you don't have to tell me which CEO emailed you, although I would love it if you did. But give me an example of a company that you're very comfortable, not just with what its future looks like in terms of business fundamentals, but where it's also pretty good value that you could buy it now.
Yeah, Horizon. Horizon's a great one. They're the largest rail haulage company in Australia. They own a rail network in Queensland, which is a regulated asset, so those returns are pretty much locked in and actually move up with interest rates. So those assets are come upgrade, and then the other part of their business is the haulage. So they own the wagons that go on the rail, and they have very long contracts with miners, metallurgical coal, thermal coal, and the majority of that business is bulk, which is grain, lithium, iron ore.
So would it be fair to say that basically in this environment you just look for those companies with assets that are effectively rent-seeking, that no one else can get access to, and you just draw that income from it and at least stay sort of that defensive attitude while we're sort of playing out this kind of hairier stage of the cycle?
Look, we're always interested in investing in good franchises, companies with a strong competitive advantage, companies with those recurring earning profiles, with good management that can grow over time and trade at a reasonable price. The difference is the market's interest in those companies can go up and down, and no, we're definitely seeing a bit of a shift in the market's interest at the moment.
So with Horizon, at what type of a time frame are you thinking of it? Because right now, all the bulks are going so well. Great agri season. Coal, is being dug out as fast as it can be to get it the prices that are being achieved right now. But then there is that exposure to dirty fossil fuels. So if you think about it with an ESG overlay,
Sure.
or in these volatile times, do you lighten up that ESG overlay as well?
Look, the thermal coal, that's part of the reason it's quite a cheap investment, because people are really worried about the thermal coal exposure. It's 30% of their business. The really sort of good news story about Horizon is, as those thermal coal mines slowly shut down, they can redirect those haulage wagons to their bulk business. So we're talking lithium, we're talking grains, and copper, nickel, and we see the growth outlook for those industries very strong. If you look at grain, half of the grain market is still trucked. So from an ESG perspective, we see huge growth potential for rail, because it's, in terms of emissions, about 1/7 of trucking. So we see market share opportunities to the rail industry as well.
Yeah, I don't think we talk enough. Anyways, this is another conversation, but about the emphasis that we should be putting on transport and trains in that regard. Now, I know another one that you had on your list was Amcor.
Yeah.
Didn't Amcor hit a record high last week?
It did.
Okay,
yeah.
so is there still value in Amcor?
Yeah, look, when we wrote the article, we saw the stock was sideways for 5 years. And its earnings had compounded at sort of 5% per annum. And then it released a quarterly result a few weeks ago. And suddenly, to us, there was nothing special about the result, but for whatever reason, the market liked it. And it's actually up 25% in the past 6 weeks. So I wouldn't be recommending people go out and buy it today. But it's still reasonably priced. It's on around 16 times earnings, pays a 4% yield. And it's delivering that 3 to 5% per annum growth each year. And if you think of its customer set, it's consumer staples. It's food, it's beverages, it's healthcare. If we have a recessionary environment, they'll hold up really well.
I mean, is that what investors are looking now for, you think? Just different thematics to be able to trade on? Because like you said, the company's fundamentals hadn't really changed that much, but all of a sudden it's the flavour of the month.
Absolutely. Investor sentiments had a major shift in the past 6 months. Risk appetite has changed in a major way. And that's the reason we're seeing crypto down 60%, unprofitable tech down 60 or 70%. The Nasdaq's down considerably, whereas these companies are actually going up.
Yeah.
It's been a major change. And no, for us, it's been welcome.
I was going to say, has your job become not easier, but you've got more to pick from, presumably?
Yeah, well, the flip side is some quality growth names have also been sold off, really, pretty aggressively. And that, every now and then we get a chance to buy some really high quality growth names every cycle, and we got that post GFC last time. We were able to buy some amazing healthcare companies on 16 times and 15 times. Believe it, ResMed, we bought on 15 times net cash last cycle. Hopefully we get some chances to buy those quality assets again. But yeah, so we're looking and watching.